Welcome to the deep dive. Today we're diving headfirst into one of the biggest stories shaking up global finance right now. A truly profound and, well, persistent weakness in the US dollar.
Mhm.
The US dollar index, or DXY, that benchmark for the dollar's value, is currently testing multi-year support levels, stuff we haven't seen since, March 2022.
That's right. It's a really significant
It
point.
feels like a seismic shift, and it's, well, critical to understand. So our mission with this deep dive is to unpack the layers, give you a shortcut to being truly well-informed on what's driving currencies today, June 27, 2025.
Right. We'll look at the data, connect the dots,
Exactly, and help you understand why it matters.
and here's where it gets particularly time sensitive. As we speak, the session's pivotal event is just hours away. That's the release of the U.S. Core Personal Consumption Expenditures, or PCE, price index for May, 8:30 a.m. Eastern.
Yeah, the big one.
It really is. For you, remember, the PCE is the Fed's preferred inflation gauge. Now, market consensus is looking for a slight year-over-year increase to 2.6%. Why is this so crucial? Because, honestly, any deviation from that could trigger an immediate sharp reaction in the dollar. A lower number fuels more selling. A higher number might give it a brief lifeline.
That's a critical point. Really clarifies how much is riding on today's data. So with that essential context, let's dive in. Let's unpack this.
Let's do it.
We're diving into why the dollar is feeling so weak, what the major central banks are doing, and how it's all playing out across 5 key currency pairs. So let's pull back the curtain on the central drama here. The incredible shrinking dollar. I mean, the headline everywhere is this precipitous fall. The DXY is at its lowest since March 2022, like we said, and it's on course for its 6th straight month of declines. 6.
It's a strong trend.
And it's broad-based, too, right? It's
Yeah.
not just one thing. Euro, sterling, both hitting multi-year highs against the greenback.
Yeah, and what's fascinating here is that even significant geopolitical tensions didn't really rally the dollar. The recent Iran-Israel de-escalation.
Yeah.
Usually you'd expect some safe haven buying.
Right, but not this time.
Not this time. Which just underscores the depth of this bearish sentiment.
Yeah.
It isn't just technical chart stuff. It's fundamentally driven by a stark and I'd say widening policy divergence between the big central banks.
And that policy divergence is huge.
Yeah.
Let's dig into that. The U.S. Federal Reserve, for instance, they've adopted a decidedly dovish stance.
Very much so.
Which, for you listening, dovish means they're signaling lower interest rates are likely, trying to stimulate the economy, and markets are, well, they're pricing in more cuts.
That's right. Now, contrast that with the European Central Bank, the ECB. Okay, yes, they did cut rates recently, 25 basis points on June 5th.
They did.
But, and this is key, they maintained a comparatively hawkish, data-dependent posture. President Lagarde basically said, hold on, this isn't the start of some preset cutting cycle.
So more wait and see from them.
Exactly. Hawkish, meaning they're still worried about inflation, less keen to cut quickly, and that provides a firm underpinning for the euro. Meanwhile, you've got the Bank of England being, let's say, cautiously dovish, and the Bank of Japan, well, they remain very dovish. They're even slowing the pace of their bond tapering, which still keeps rates quite low.
So what does this all mean for the why behind the dollar's struggles? Is it really just about interest rates, or is there more to it for you to grasp?
Well, think of money like water, right? It flows towards the highest yield or, the best return. When one central bank, like the Fed, is clearly signaling cuts, it makes holding that currency, the dollar, less attractive.
Like a shallower pool.
Exactly. So that smart money flows out, looking for better yields elsewhere.
Yeah.
So yes, rate differentials are absolutely key. But it's also about the direction of policy, the conviction. And the Fed is signaling a very different direction than many others right now.
And layering onto that, we're seeing reports, the Wall Street Journal mentioned it, suggesting President Trump is considering an unusually early nomination for Fed Chair Powell's successor.
Yeah, that's adding another layer of uncertainty.
And the market's interpreting that as an attempt to install more dovish leadership.
Precisely. And that kind of political overhang, well, it erodes confidence in the dollar. It intensifies those bearish bets because it just hints, at a potential compromise of Fed independence.
Which is usually seen as crucial for currency stability.
Absolutely. And just to be clear, we're relaying the market's interpretation of these reports, not taking a side.
Of course. Now, we've also got some interesting cross currents in the U.S. economic data itself. Makes it tricky.
Very mixed signals.
Yeah, like Q1 GDP revised sharply lower, a 2.5% contraction driven by lower consumption, but then, boom, made durable goods orders surge 16.4%. Mostly aircraft, but still.
It's a real head-scratcher, isn't it? That ambiguity makes it tough to get a clear picture.
Right.
And the labor market shows similar mixed signals. Initial jobless claims fell, which, okay, that's good. But continuing claims have been creeping higher. That suggests maybe a cooling employment landscape.
So connecting the dots.
Well, if you connect this to the bigger picture, this mix of weaker growth and maybe a softening job market, it gives the Fed's dovish members a pretty strong reason to argue for rate cuts, which, again, weakens the dollar outlook.
Okay, and one more piece. Geopolitical de-escalation. We saw that rapid unwinding of the war premium after the Iran-Israel ceasefire agreement. Oil prices dropped back towards $65.
Yeah, and how did that impact the dollar? Well, it removed a key pillar of support.
Huh.
That reduction in safe haven demand, people weren't rushing to the dollar for safety anymore.
So its fundamental weaknesses took over.
Exactly. They could really dictate its trajectory.
Okay, let's do that quick central bank dashboard. Fed, 4.25 to 4.50% dovish. ECB, 2.00% hawkishly neutral.
Yeah, I'd call it that. Bank of England,
Mm.
4.25%, cautiously dovish. Bank of Japan, 0.50%, still very dovish.
Got it.
And remember that ECB hawkish cut on June 5th. Lagarde really emphasizing data dependency, signaling maybe a pause, not a guaranteed cutting cycle.
Big contrast to the Fed.
Huge contrast to the Fed's clear easing bias, and Powell acknowledging potential earlier cuts if things weaken. It's really a tale of two very different policy paths right now.
Okay, market snapshot time. Quick look at the last 24 hours ending June 26th. EUR USD near 1.170, multi-year high. GBP USD, highest since October 2021, near 1.3733.
Feel very strong.
USD JPY is weaker, down in the 144.70 range.
Yeah.
And the DXY, yeah, lingering at those multi-year lows, 97.18 to 97.38-ish.
Stuck down there.
So what about the smart money? The Commitment of Traders report, the COT report, gives us that peek behind the curtain at what the big funds are doing.
The institutional view. The latest data, which is as of June 17th, released June 20th, it shows some interesting stuff.
Okay.
For the euro, large speculators significantly increased their net long positions. Shows real conviction there.
Bullish euro.
Definitely.
Yeah.
Now the pound, interestingly, large specs hold a net short position. But, and this is important, that data is probably a bit stale. It likely doesn't capture the really strong rally we've seen just in the past week or so.
Okay, so expect that to change, maybe.
I'd expect a big shift in the next report.
Yeah.
More balanced, maybe even net long. The yen shows a massive net long position. Now, we interpret that less as a pure bet on yen strength and more as maybe a USD-centric hedge.
Betting against the dollar using the yen.
Kind of. Or maybe some residual debts on BOJ normalization that haven't fully unwound. Now, the dollar index itself, significant net short position among the large specs, confirms that institutional bearish view on the dollar.
Right.
And finally, CAD and AUD. Large specs hold sizable net short positions against the U.S. dollar, which, as you noted, kind of contradicts the recent price action, especially for the Aussie. That definitely needs a closer look.
Okay, so that sets the stage. Now, this is where it gets really actionable for you. We've laid out the big picture, but where are the most compelling opportunities right now? We've narrowed it down to 5 pairs. We used a weighted scoring model, looked at narrative strength, volatility, anomalous sentiment, and liquidity. Gives us a diverse set of potential moves.
Good process.
First up, Euro USD. This is our bullish pick, confidence score 9 out of 10. This pair really is the epicenter of that policy divergence. Super dynamic.
Absolutely. And technically, Euro USD is at a huge juncture. It's testing a critical long-term level around 1.1500. That's a multi-decade channel going back to the 80s.
Wow.
A confirmed reclaim there would be massive. Right now, trading around 1.170, it's decisively broken recent highs, moving averages, all screaming strong buy. And the RSI, the momentum indicator, it's bullish but not yet overbought. Still room to run.
And fundamentally driving it, that Fed dovishness versus the ECB's hawkish pause, we expect that PCE data later today if it's at or below what the market expects.
This is 2.6% year over year.
Right. That'll just reinforce the USD selling, basically confirm the market's current thinking.
And the sentiment picture is just overwhelmingly bullish for Eurodollar retail sentiment. Hugely lopsided, like 72% to 79% of retail traders are short this pair.
That's a contrarian signal, right?
Massive contrarian signal. It creates this significant pool of potential buy orders from stop losses. Think of it like fuel for a continued squeeze higher. like a compressed spring.
Okay.
And the AI, the order flow, confirms it.
Mm.
COT data shows the smart money, the institutions, are heavily net long EUR futures. It all lines up. Potential price zone.
Yeah.
We're looking at 1.1650 to 1.1780.
Right, from the euro's steady climb, let's pivot. Let's look at a pair known for its wild swings. GBP-JPY, often called the dragon or the widowmaker.
Yeah, for good reason. High volatility.
This one's our bullish breakout pick, confidence score, 7 out of 10. So still pretty strong, but maybe a bit more caution needed.
A bit more caution, yeah. Technically, it's approaching multi-year resistance near a 198.85. That's a big psychological level.
Hmm.
A decisive break there targets 200.00, the big figure. RSI is elevated, but again, not quite overbought, so there's momentum.
And the fundamental story, it's that interplay, right? UK inflation, which is still persistent even if falling, keeping the Bank of England kind of cautiously dovish, versus the Bank of Japan's very explicit, cautious, dovish stance. They're slowing their bond purchase tapering, signaling rates stay low.
Exactly. And sentiment-wise, similar story to Eurodollar. Heavy retail short positioning, about 66 to 70% short. It's a strong, contrarian, bullish signal.
Okay.
Plus, a low VIX, low market volatility tends to support these risk-on carry trades. Makes it attractive to borrow low-yielding yen and buy higher-yielding pound.
Now, what about that CO2 report contradiction? Large specs, net long JPY futures.
Right, we touched on that. It looks contradictory, but like we said, it's almost certainly a USD-centric hedge. A bet against the US dollar, using the yen, rather than a specific bet on yen strength against the pound.
Gotcha.
The main risk here, a sudden risk-off shock, something spooks the market and everyone piles back into the yen as a safe haven. That's the risk.
Oh.
Potential price zone, 197.7 up to maybe 200.0.
Okay, moving on. USD CAD. Our
Yeah.
bearish pick here, confidence 8 out of 10. This one's obviously tied to broad USD weakness, but also Canadian UDP data. That's also out at 8:30 a.m. Eastern. Consensus is just 0.1% month-over-month growth.
Yeah, so any upside surprise there could really kick the Canadian dollar higher, pushing USD CAD lower.
Right.
Technically, USD CAD is in a clear, persistent downtrend, trading below all the key moving averages. It's currently testing key support, around 1.3624 to 1.3640. A break below that zone is pretty crucial.
And fundamentals. Pervasive USD weakness helps, and stable oil prices around 65 per barrel give the CAD a decent footing.
Exactly. And sentiment on USD CAD is interesting too. Retail is 67% long the pair.
Betting against the trend again?
Betting against the trend provides a clear, contrarian, bearish signal for the pair.
Okay, and you mentioned this trap trader idea here too.
Yes, this is really important for USD CAD. The COT report shows large speculators are actually net long USD CAD. They're fighting the downtrend.
So they're losing money on those longs right now.
They're underwater, exactly. Now, if that key technical support around 1.3624 fails, it could trigger a cascade of stop-loss orders from these trapped institutional longs.
Forcing them to sell to cut losses.
Exactly, which leads to a rapid, sharp price decline, like a coiled spring releasing, but downwards. So potential price zone, 1.3530 down to maybe 1.3680 on the top side, but really conditional on breaking that 1.3624 support.
Makes sense. Next up, AUD-USD. Another bullish pick. High confidence here too, 9 out of 10. The Aussie dollar. Classic risk-on proxy, right? Benefiting when markets feel good.
Absolutely. And it's been a primary beneficiary of this broad USD weakness. Price action. Textbook bullish. It broke out of a falling wedge pattern. It's typically a bullish reversal signal.
Okay.
Hit a new 7-month high at 0.6564. All the key moving averages are pointing higher. Confirms the upward momentum.
And fundamentally, that stable risk-on mood helps low VIX, stocks rallying. Plus, the Reserve Bank of Australia is holding steady on policy, which contrasts nicely with the dovish Fed.
And sentiment, another really strong contrarian signal. Extreme retail short positioning here, 73% short.
Wow. Powerful fuel.
Powerful fuel for more upside. Those shorts eventually need to cover, which means buying AUD-USD. And the AI, the order flow data, aligns perfectly. COT report shows large specs are net long AUD futures. Everything points bullish. Potential price zone, 0.6510 up to 0.6620.
Looks compelling. Okay, finally, USDMXN. The Mexican peso, another bearish pick for the dollar here. Confidence 8 out of 10. This pair's been in a really persistent, powerful downtrend. Just stands out.
It really does. Technically trading well below all key moving averages. The RSI isn't deeply oversold yet, suggesting there's still room for it to run lower. Key support is down near 18.85.
And the fundamental driver, it's that carry trade, isn't it?
Dominantly, yes.
Yeah.
Just to refresh for you listening. A carry trade is borrowing in a low interest rate currency, like the dollar is becoming, and investing in a higher interest rate currency, like the peso.
And Banxico's rate is way higher than the Fed's.
It's exactly. Banxico near 8.00%, Fed at 4.25, 4.50%. That differential is huge, makes the carry trade incredibly attractive, and it's amplified by the broad USD weakness. Plus, general anti-USD sentiment acts as a big tailwind for the high-yielding peso.
And that trapped trader scenario again, like USD CAD.
Absolutely. It's a very similar setup. The COT report shows large speculators are net long USDMXN. They are fighting this powerful downtrend too.
Underwater longs.
Underwater longs represent a significant pool of potential selling pressure. If that key 18.85 support level breaks, it could be the catalyst, forcing those trapped longs to capitulate, bail out of their losing bets.
Which means more selling, faster declines.
Essentially, rapid and sharp declines. Yeah, potential price zone here. 18.750 down to maybe 18.9500 on any bounces.
Okay, so let's synthesize all that, give you the clear takeaway. We're seeing really strong convergence in the analysis, especially for USD and AUSD, both 9 out of 10 confidence. A consistent narrative across the board.
Yeah, the pieces fit together pretty well.
Yeah.
And understanding that trap trader phenomenon, particularly in USD CAD and USDMXN, it gives you a deeper, really actionable layer of insight. It's not just about the indicators.
Right.
It tells you where the market might find extra fuel for faster moves, especially if those key support levels give way.
Okay, let's quickly recap that final summary table, those actionable insights for you.
Mhm.
Euro USD, retail 72% short, trend, bullish, zone, 1.1650, 1.1780, confidence, 910.
Strong conviction.
GBP JPY, retail 66% short, trend, bullish breakout, zone, 1.3530, 200.00, confidence, 710.
Get more volatile.
USD CAD, retail 67% long, trend, bullish, zone, 0.6510, 0.660, confidence 910.
Another strong one.
And USDMXN, retail N8, trend, bullish, zone, 18.7500, 00, 18.95, confidence 810.
Carry trade plus trapped longs.
So today, we really dove deep into the forces driving the FX market, didn't we? Particularly that persistent US dollar weakness. You should now have a clear understanding of the policy divergences, the economic cross-currents, even how the big money is positioned.
Yeah, and our goal is always to give you those aha moments, Cut through the noise, give you the most important nuggets so you feel genuinely well-informed.
And as a final thought for you to mull over, what have you got?
Well, we've seen how political considerations can influence the market's perception of central bank independence, like with the Fed chatter.
Yeah.
So consider this. How might that dynamic play out in other major economies? What could that mean for global financial stability beyond just currencies? Something to chew on.
Definitely food for thought. Thanks for joining us on the deep dive.